Have you ever wished you had, I don't know, a weather forecast for market storms? A way to spot those huge risks that the usual financial models just seem to miss? Well, today, we're going to dig into a statistical tool that does pretty much that. It's called Kurtosis.
All right, so to really get why kurtosis is such a big deal, we first have to talk about the world that a lot of financial models think we live in. You know, this perfect little world where everything is neat, tidy, and super predictable.
But let's be real for a second. Is that really how markets work? Are they as neat and tidy as a coin flip? I think any investor who's been around for a bit, especially through some tough times, knows the answer is a big, fat no. So this right here, this is the textbook model. It's the normal distribution, or what most of us know as the bell curve. And in this perfect world, everything kind of bunches up around the average. Those really big, crazy outcomes, way out on the edges, they're supposed to be super, super rare. The real kicker? A ton of core financial theories are built on this exact idea. But, yeah, that neat little model, it just doesn't hold up in the real world. The reality of finance is way less like a gentle hill and a lot more like a wild, absolutely unpredictable roller coaster. And this is where you can really see that difference. See, actual financial returns, they tend to have what we call fat tails. Those edges on the graph are just thicker, heavier. And what that means is those extreme events, the huge market crashes or the massive rallies, they happen way more often than that old normal model would ever have you believe. Okay, so how do we actually measure this hidden danger? Well, this is exactly where kurtosis steps in. It's the tool that helps us put a number on the risk that's hiding out in those fat tails.
So what is kurtosis really? In a nutshell, it's a way to measure the extreme values, the outliers, on either side of a dataset. Now, it's not going to tell you if the market's going up or down, but what it will tell you is the likelihood of seeing something happen that's way, way far from the average.
A lot of people get this mixed up with another stat term called skewness, and they're related but different. Skewness is all about asymmetry, like does the graph lean to one side or the other? Kurtosis, though, couldn't care less about the lean. It's all about the tails, the potential for those crazy outliers on both ends.
And this is a really key point from Harold DeBoer at TransTrend. He points out that the biggest mistake people make is focusing only on the fat tails. But high kurtosis is a package deal. It also means you get a much higher, sharper peak right in the middle.
I love this analogy. It's less about fat tails and more about sagging shoulders. Think about it. If you have a really high peak and fat tails, that means the stuff in between, the shoulders, has to sag down. This means there's actually a lower chance of getting those medium, boring, moderate returns. It's either a bunch of tiny moves near the average or these massive jumps, with not much happening in the middle. Okay, so we've got a handle on what kurtosis is. Now let's get into the nitty-gritty and learn how to read it. There are basically 3 flavors of kurtosis, and each one is telling us something different about the risk we're looking at. Now, to make all this easier to compare, analysts came up with something called excess kurtosis. See, a totally normal distribution has a kurtosis value of 3. That's just the number. So to make life simple, we just subtract 3 from whatever we calculate. This makes our normal baseline 0. Easy, right? So any positive number means more tail risk than normal, and any negative number means less. So here are our 3 types. First, you've got mesokurtic. That's your normal one with an excess kurtosis right around 0. Then there's leptokurtic. This one's positive, and that's your signal for fat tails and higher risk. And last, you have platykurtic, which is negative. That means thin tails, more stability, and more predictable returns. And when you see them side by side, the difference is just stark. Look at the leptokurtic one on the left. You can see that super sharp peak and those heavy tails. Compare that to the platykurtic on the right. It's way flatter, more spread out, with skinny little tails. It's basically telling you fewer surprises here. Let's zoom in on leptokurtic, or as I like to call it, the roller coaster. When you see an excess kurtosis above 0, it's time to buckle up. It's a big flashing sign that there's a high chance of extreme returns. Either way, up or down. For an investment, this means prices don't just wander around, they make huge, sudden jumps. And then, on the flip side, you have platykurtic, the gentle ride. A negative excess kurtosis means thin tails and very few surprises. The data is much more evenly spread out. Honestly, for an investor who just wants steady, reliable returns, this is exactly what you're hoping to find. Okay, this all brings us to the most important part, the so what. How can we actually use this stuff to manage risk in the real world? Well, this is where kurtosis really shines, acting like a risk radar for your investments.
The Corporate Finance Institute really nails it here. They say a large kurtosis is associated with high risk. It's that simple. It's a direct warning sign that an investment is likely to have these massive swings, for better or for worse.
And this gets the specific name, tail risk. It's the danger that an asset makes a huge move, like more than 3 standard deviations from where it is now. And that's the exact kind of risk that kurtosis is designed to spot. The kind of thing that normal models would tell you is practically impossible.
And believe me, this tail risk stuff is not just some academic theory. Just look at this timeline. The '87 crash, the dot-com bubble, the 2008 crisis. History is literally littered with these supposedly once-in-a-lifetime events that, it turns out, aren't so rare after all. And high kurtosis would have been waving a red flag before all of them.
All right, let's wrap this up. What's the bottom line here? What does all this mean for you, an investor, trying to make sense of the markets? If you remember one thing from all this, make it this. Kurtosis shows you what the averages and standard deviations try to hide. It reveals the potential for those stubborn, extreme events that can absolutely change everything for your portfolio.
So, once you know the risk is there, what do? Well, knowing is half the battle. You can start using strategies to manage it. Things like stop losses to protect your downside, buying options as a hedge, diversifying into things that don't all move together, and really stress testing your portfolio against those black swan events. These are all ways to prepare for the tail risks that kurtosis helps you see. So I'll leave you with this. Think of it like this. Standard deviation helps you measure the normal bumps in the road. Kurtosis, on the other hand, warns you about the cliffs. The question you have to ask yourself is my portfolio prepared to handle that difference?